Hello, welcome to the Wealth starting line. Don't forget to like, comment, share, and subscribe.
You ever look at the crypto market and just feel like you're watching two completely different movies at the same time? I mean, in one, you've got companies making profits so huge they're actually dwarfing Wall Street banks, and in the other, you've got experts screaming from the rooftops that the whole thing is basically a house of cards, just one little shock away from total collapse. So today, we're going to try and untangle that contradiction.
Okay, so let's just dive right in. For years, the big promise of crypto was simple, right? It was supposed to be a safe haven, digital gold, something totally separate from the whims of governments and their central banks. But the reality we've been seeing lately, it tells a completely different story. Instead of being a life raft, crypto started to look just like another high-risk tech stock, basically dancing to whatever tune the Federal Reserve is playing. So how can both of these things be true? Well, let's find out.
And our story really has to start with the biggest, most important, and most controversial company in this entire space, Tether. They're the ones who issue the world's biggest stablecoin, USDT. And their success is, well, it's almost hard to believe.
Get a load of this number. In 2024, Tether is on track to rake in a net profit of $13.7 billion. Now, to put that into perspective, that's more profit than financial giants like Citigroup or Morgan Stanley, companies that have, hundreds of thousands of employees. Just let that sink in for a second. A crypto company is out-earning some of the biggest and oldest names on Wall Street.
So the crucial question is, how is this even possible? We are talking about a company with only about 150 employees. If you do the math, that works out to over $90 million in profit per employee. It's a number so wild it almost looks like a typo. So what's their secret? Well, Tether's business model is almost beautiful in its simplicity. It's really just a four-step money machine. So step one, you give Tether $1. Step two, in return they create and give you one of their digital tokens, one USDT. Then, and here's the genius part, they take your dollar and they go invest it, mostly in super safe stuff like US government bonds that pay interest. And the final step? They keep 100% of the profits from those investments. You get the token to trade with, they get what's basically a zero-cost loan that they use to make a fortune.
But while Tether is busy printing money, that core story of crypto, the one about it being a safe place to hide when things get stormy, is starting to completely fall apart. And it all starts with the OG crypto itself, Bitcoin.
This quote I saw from a recent Deutsche Bank report. It just absolutely nails the feeling in the market right now. For years, people piled into Bitcoin thinking they were buying this unsinkable ship, this Noah's Ark that could ride out any financial storm. But the data now suggests they were actually buying a ticket for the Titanic, a luxury liner headed straight for an iceberg, completely tied to the fate of the very markets they were trying to escape from.
And this chart here shows you exactly why. I mean, just look at these numbers. Bitcoin's price now has a 46% correlation with the tech-heavy NASDAQ 100. That means almost half the time when risky tech stocks go up, Bitcoin goes up. When they tank, Bitcoin tanks right along with them. It's not some independent asset anymore. It's become what investors call a high-beta tech play. In other words, it's just another risky tech investment.
And let's put this to a real-world test, shall we? On October 10th, 2025, the U.S. threatened a major trade war. This is a classic risk-off event that should have investors running for safety. So what happened? Well, gold, the old-school safe haven, did exactly what it's supposed to do. It went up about 1%. And Bitcoin? It plummeted over 5.5%. The so-called digital gold acted a lot more like digital risk. So if Bitcoin isn't a safe haven, what is it? And how does all this connect back to Tether's insane profits? Well, it turns out both of these stories are being directed by the exact same incredibly powerful force, the U.S. Federal Reserve.
Probably the easiest way to think about this is to picture a giant water faucet for the entire global economy. When the Fed turns that faucet on by lowering interest rates, cheap money just flows everywhere, and pretty much all assets, stocks, crypto, you name it, they tend to rise. But when they turn that faucet off by jacking up rates, money gets expensive and assets fall.
And the data here is just undeniable. If you look back to 2022, when the Fed was aggressively hiking rates, Bitcoin's price moved in the exact opposite direction 90% of the time. More recently, in late 2025, the second the Fed even hinted at pausing those hikes, the market rallied. But as soon as they walked that back a little bit, Bitcoin dropped 6%. It's not some revolutionary decentralized asset anymore. It's become a puppet of monetary policy.
And this is where it all ties together beautifully.
Tether's entire profit machine, that simple little model we talked about, is built on the Fed keeping interest rates high. See, they invest your dollars in US Treasuries to get that yield. If the Fed starts lowering interest rates, the return on those treasuries dries up and poof, so do Tether's profits.
So what's Tether doing to get ready for this? Well, it looks like they're taking on more risk. A lot more. Take a look at their reserve breakdown. According to S&P Global, nearly a quarter of the assets that are supposed to be backing USDT are now in riskier things like corporate bonds, gold, and yep, even Bitcoin. They're chasing higher returns because they're worried about falling interest rates, but by doing that, they're raising the risk profile for the single most important stablecoin in the world.
So, what we have here is this perfect storm brewing. You've got a so-called safe haven that acts like a risky stock, and you've got a so-called stablecoin that's taking on more and more risk to keep its profits up. What does this mean for the future and for anyone who's actually holding these assets?
For stablecoins, the advice from analysts is actually pretty clear. First, diversify. Don't keep all your eggs in that one USDT basket. Second, use them for what they were made for. Transactions, moving money around, not as a long-term savings account you just hodl. And finally, you gotta watch the signs. Pay really close attention to those reserve reports and any credit rating changes. They are the canaries in the coal mine.
What's really interesting is that Tether itself seems to see the writing on the wall here. They're now launching a brand new separate stablecoin called USAT. And this one is designed from the ground up to be fully compliant with US regulations. It's a classic two-track strategy, right? Keep the old, freewheeling, global USDT running while you build a new, regulated one for the buttoned-up world of big institutional finance.
And all of this brings us to one final big question. Bitcoin is now basically a puppet of the Fed. The largest decentralized stablecoin is launching a regulated US version to make Washington happy. So you just have to ask yourself, has this whole grand experiment, this idea of creating a new independent financial system, has it just been tamed, co-opted, and absorbed by the very system it was supposed to replace? Something to think about.
Thanks for watching. Don't forget to like, comment, share, and subscribe. See you next time.